Ladies and gentlemen, we're going to wait for another few minutes before we start this fireside chat. Shut up.
Yeah, sir.
Hi, I think we should start.
Recording in progress.
Ladies and gentlemen, thank you so much for coming on to the Napian Capital Leadership Series. Today, we are proud to invite Shalabh Saxena, Managing Director and CEO of Spandana Sphoorty, India's third largest microfinance company, to a fireside chat. I want to give a brief introduction of Shalabh before we start the chat. Shalabh Saxena has over 28 years of strong experience in the consumer banking and the life insurance industry. Throughout his career, he has run large profit centers and SBUs across marketing, strategy, information technology, planning, alliances, and acquisitions. Shalabh is an economics graduate with an MBA in marketing from the BK School of Management, Ahmedabad, and previously worked at Bharat Financial Inclusion as MD and CEO. It's a unit of IndusInd Bank, as you would know, and then was also the Chief Operating Officer of HSBC Life Insurance, and also had other roles in ING Life Insurance and Standard Chartered Bank. With that, Shalabh, we want to kick it off with getting a bit of an overview from you with respect to Spandana before and Spandana after you've joined and the changes that you've made.
Sure. Thank you very much, Gautam. Good evening to you and to everybody on the call. Thank you for inviting me. It's really an honor to kind of have a chat with you and explain the experiences that we have had over the past couple of years. Incidentally, Gautam, tomorrow is when we exactly 2 years back on the 19th of March 2022 is when we joined, or when I joined Spandana. So today is exactly the day when we complete 2 years. Anyway, so so good evening to all of you. I think just by way of a brief introduction, I've been into retail consumer banking and people side for almost 29 years that I've been working. My exposure to microfinance was with Bharat Financial in 2018 February when I joined, and this from 2018 February until March of 2022. 4 years is when was I really understood the fascinating business of microfinance. One of the things that one understands when you handle a business of this scale is the enormity of the opportunity. As you go, because none of us, and I can say this with surety, we really haven't seen what a Bharat is, what a so-called rural India is. I will refer to rural India as Bharat because, that's what typically I keep on saying. India is divided into two. There is an India and there is a Bharat, while the gap is being bridged, but still Bharat is way behind, many years behind. So, but yes, the government and all of us, everybody's are taking their steps to ensure that the Bharat sort of aligns with the new India, and there is a there is a lot of opportunity which is there and which we'll cover during the course of the presentation, so that we or during the discussion, so that all of you and all of us are aware about what is the headroom that we are talking about or what we are anticipating when we talk about the microfinance industry. So back to quickly winding up my interview, so 4 years I was with Bharat Financial, 2 years of COVID including. Just to give you a sense, about 13% of when I was in Bharat, 13% of assets were contributed into the IndusInd Bank, and the profit was almost a quarter. So this is, as all of you are aware, this is a high ROA, high NIM business, but provided you know how to run this, that's extremely critical. In this business, you blink and you miss it, and then the repercussions are catastrophic. So one has to be very clear. This is a execution focused business with all eyes on the ball and all hands on the deck. There cannot be a moment of silence or a moment of relaxation, as they say. So so we took I joined the company about 2 years back. I'll just paint a picture as to what was the environment then and what has happened over the past 2 years. So the number one, the industry itself was coming out of the woods when the COVID was just about over, and things were regularizing fast. But there were some internal disruptions which I'm sure all of you are aware about in terms of what was happening to the company. So amongst the there was a scenario where we had an outgoing MD and founder of the company, and there was a time when we came in. So when I joined, what was the narrative in the market obviously was that there was a lot of work to be done, starting with the quality of the book. Just to give you an idea, about 40% of the book was in arrear. Now, this was some bit of, or a lot of it was to do with COVID, some bit of it to do with disruption that was happening at that period in time when, ideally, the entire organization should have been converging in terms of regularization. At that time, there was a management transition, and hence the casualty of a management transition kind of played out. That was number two. Number three was the relationships. The relationship, be it the lenders, be it the regulator, that was on a pause. Everybody was waiting and watching to see how it unfolds. But to put it mildly, it wasn't the greatest of situations to be in. Number four, and normally this particular point I always put it number one, but in the sequence of the way it was, how do I describe the whole thing? Number four was the quality of people at a leadership level. The field was intact. The field, the branches, they were good. And like any microfinance company, it's never, they are always insulated from boardroom or head office, whatever is happening in the head office. But so, so to that extent, that was a face saver, so to say. But people, when it comes to quality of people at a senior CXO level, is something that was missing. Spandana was always, it was It never was known for the vast variety of experienced people that you would have. So that was another one which a challenge that was on the table. And the last was culture. What and as we progress in the discussion, I'll just explain as to what do I mean by culture. So these are the five things that when I took over, and I did not come alone. Obviously, I had the CFO, who was also my colleague, CFO in my previous organization, Bharat Financial. So he walked in, and then people priority was number one. We started with five priorities. If you go back to our earnings call, the Q4 result we presented, the book was, as I told you, 40% earlier, and at that time in that particular balance sheet, we had a GNP of almost about 17.5%. Now, financial services balance sheet with that kind of a number is obviously, people won't touch it. But then we, as a team, were confident that we'll be able to turn this around for the opportunity that exists, and the work that was clearly chalked out or charted in our mind. So we focused on people first. We got we came out with the when we spoke to the when we presented the results, and when we spoke to the media, we said we've identified about 13 CXO positions which we will fill in the next 1 to 2 quarters. That was the topmost priority, because we strongly believe that as a professional. So this company was moving from a founder-driven company to a professionally run company. So that was the mandate that the shareholders had given, and that's the reason why I walked in. In my previous organization, I built the book. When I joined, it was about 11,400 odd, and when I left, it was 30,000 crores. So so that was the journey that I, along with the team, traveled, which includes those 2 years of COVID, and with industry losses, just about 60% of the industry losses. So so to that extent, we had a fair sense of how the whole this whole thing works. We were lucky enough that a lot of people from our previous organization joined this company. They joined it for one, they thought it was a good opportunity, number one. Number two, every professional in their life wants to do that one bit, when you talk about something called a turnaround. I'm not saying, the company is still, we're in that stage where we can call it a turnaround, but I think, the vectors and the general things that we see, the progress has been pretty much slightly ahead of what we had planned, so let me put it that way. So so we had the CXOs coming in. We were able to fill all the 13 positions in about 2 quarters, and ever since then we've been kind of building this whole story. We had a plan in our mind that the next 3 years we have to do something, and what that do something, we came out with something called a Vision 25. This was on the 11th of July 2022, which we presented to the market, saying, look, the next plan, this is what we are going to do, which includes the people, the technology, what is the geography, what are the distribution, what is it that you're going to do in terms of the volumes, what will be your ROE, ROA, and so on and so forth. All of that we did. So we came out with 5 clear priorities when it came to taking over the company. The first was people, and I mentioned this. People is 1 to 10 in financial services. If you can take care of the people, your 90% job is done, and empower them. So just warm bodies does not help. So you do and get the best people, do whatever you can, which I can say this right, that we did it very well. We, along with the team, we have a manpower which I believe is the best in the industry, from an experience, from a scale, from handling disruptions, from handling all the the environment issues that the past, be it 2011 Andhra crisis, or demonetization, or COVID for that matter. Apart from that, there you have those floods, etc. But the point is, the larger point is that we have the best team. We were, and I keep saying this, that we are very thankful that all of them saw a vision, saw an opportunity, and are pretty excited about the fact that let us join this company for the larger growth, both personal as well as career. So that was what. So 5 priorities we identified. Number 1, people. Number 2, governance. We knew we had to kind of do this, and we had to crack that whole part, so that the questions that get asked around the governance and risk matrix obviously are taken care of. That's number 2. Number 3 is risk. Inherent microfinance is a risk management business. It is not an asset management business. I've said this multiple times. I'm saying this again. Obviously, I'm seeing you for the first time, but public statements made, I've made this point that, this is, if you know how to handle risk, this is the business to be in. Don't do microfinance because you think it's a good asset business. Yes, the segment is a credit hungry segment. You'll never have a problem giving loans, but getting the money back is extremely important, and hence important that you run processes in such a way that there is no scope for any error. I say this and I use this statement a lot. I've just said in this discussion that this is a execution focused business. We teach people not to think, and I mean it in all the good sense. The people are taught that this is your process, this is the sequence of the process, please do not deviate. So if it is 1 2 3 4 5 6 7 8, you have to exactly do 1 2 3 4 5 6 7 8. You cannot do 1 2 4 3. That's not an option. And this is what, a lot of effort goes into training, etc. And that's how we kind of build it. So back to, the top 5 priorities: people, governance, risk. Technology was point number 4. Very important that we kind of set it right. All of you are aware about the situation in which this whole disruption happened in the company and the management transition happened. So technology was something that we had to fix immediately, which includes the LMS, which includes the LOS, which includes the way you conduct the business, which includes the way you store the data, and so on and so forth. So that's the number 4. And number 5, which is the entire distribution piece. What is the ethos of you as a company? What are you going to do? Are you going to do a weekly model? Are you going to do a monthly model? Are you going to do a fortnightly model? What are the geographies where you will operate? This is very critical, and I'm just kind of highlighting this because geographical concentration is one of the biggest mitigant, when you are operating in this business. So to the extent possible, you should keep yourself very well diversified. No particular state should contribute more than X percentage. That X percent is a factor of what you as a management feel is the right number, and at the same time optics also allows you to ensure that it shouldn't be a jarring number. So when we took over this company, there were a couple of states at 17%. In our vision 25, we very clearly said that in the next 3 years we will ensure that no single state contributes to more than 12 to 13%. So that and how do you do that? 2 things. We said we identified 7 focus states. We said these are the 7 states we will grow disproportionate to the other states. The reason why we identified those 7 states were the market share of Spandana in those 7 states was minuscule, 0.5%, 0.2%, 0.5%, and so on and so forth. So the 7 states were predominantly north: Gujarat, Rajasthan, Haryana, UP, Bihar, West Bengal, and 1 state in the south, which was Tamil Nadu. We said these are the 7 states where we are going to grow. So end of FY15, you will not have any state more than 12 to 13%, and we'll have a very well diversified, portfolio. This is where we started with, and to be fair to the environment and the stakeholders, I think we got very good support. People, both the lenders and the communities, and the general stakeholders like yourselves and everybody, they kind of understood our story and where we are coming from. From then on, we are just marching ahead. Our last declared result. So when we wrote off the 700 crores of chunk, and we wrote it off because of that it was a COVID pain which had to be kind of written off. That was Q1 of FY23. When we presented that result, which was Q1 of FY23, our AUM was down to 5,500 crores, 5,511 crores odd. We declared the December results, which is 6 quarters from then. We ended the quarter at about 10,404 crores. So we crossed 10,000. Spandana, in its 2.5 decade old existence, the first time it crossed 10,000. We are at 10,004. We were at 10,404 crores end of December, and then obviously there's a full this quarter. We are a few days away from the quarter end, and suffice to add, while without mentioning the numbers, but I think we are we've gathered good traction. So overall, Gautam, sorry, long answer to your short question, but it's very important that I explain the background before we really walk into the next steps.
So I guess what you're saying is that I remember we've been shareholders, we've been happy shareholders. And I think we obviously got into the stock after meeting you over a year ago. And that was really the turning point for our decision to invest in this company. But I guess the stress recognition and the reported gross NPL of 15% in the fourth quarter of FY22, what do you think caused it? Was it just what you said, COVID, or there were other factors that caused the gross NPLs to go, rise as much as they did?
It was both, Gautam, because what happens is that COVID built up, it was COVID over a period of about 6 to 7 quarters. The portfolio built up and somebody had to kind of redress that immediately.
Yeah.
So if you go back to the COVID times, COVID one, you had a moratorium leeway from the regulator. They had come out with a moratorium guideline saying, if you want to give moratoriums to the customers, you can give by a certain date. I think 30th September of 2021, 20 was the date. Then they came out with in COVID 2, which was the phase 2, where which was more which kind of aggravated the deaths, etc. That in that phase they came out with a restructuring option. So from a regulator point of view, I would say they took all the right steps. However, our company, because at that point in time, was sort of, there were other distractions at that time. So, it was a blink, as I would say. There wasn't somebody should have kind of at that point in time should have handled it in a way that the customers are given an option and so on and so forth. But then you had a situation where there was a management transition, and hence here even one day, forget one day, even 1 hour is important. And hence, because of that gap of about 3-4 months, we were where we were, and we landed up in that situation of about 15-17% of GNPA. And hence that's the reason why, Gautam, when we met up in the very initial stages, there were many questions you did not ask, but there were others who asked, why did you really recognize such a big number? And I said, look, this is the right thing to do. It is not about an institution is not just about balance sheets. It is about what is right. We did what was right. In hindsight, we've been proven correct, so that was the right thing. And that's how, and thankfully, almost everybody without an exception kind of understood our side of the story and appreciated, and then they supported.
Sure, sure. I guess, the next point I want to talk about is a Vision 2025. You clearly laid it out. And, doubling AUMs, or now, I guess you've crossed 10,000 crores, but taking the AUMs to 18,000 crores, increasing customer base to 40 lakh customers, that's 4 million customers, achieving industry best credit practices, etc. Where are we? Are we on track right now on those goals?
So during the course, Gautam, we've taken steps which are not really popular, and I go back to the statement that I made a few minutes back.
Yeah.
Institutions have to be robust. They have to survive irrespective of people or time or that is a critical mass which, when you build in a nice way, it has to keep rolling. So when we articulated the Vision 25, we were very clear as to what are the right things to do. Yeah, we can decide and debate on the timing, but that will happen. There's no doubt about it. And hence, we had taken some steps which, as we progress in the discussion, we will have a elaborated discussion. But broadly speaking, we have tick boxes on almost everything, barring a couple, and that too, they are not reds. We have ambers. Let me give you the easier ones. And this is, we are very close to the year end, so apologies if I am not very specific about the numbers, but I will say what I've been speaking publicly. We will end this year, and this is a part of the Vision 25 as well. We said we will end Vision 25 ends next year, Vision, which is FY25. This year, we had said that we will end around 12,000 crores. We are on track. We had said that, we will geographically spread in the states that I had spoken about. We are absolutely on track. We had said that all the new branches that we open will be weekly branches. That's indeed the case. We've kind of done that. We've opened 545 branches, which are all weekly now. And slowly this whole distribution will change from a monthly to a weekly, and we'll discuss it in a bit. That's number 3. Number 4, we said in the Vision 25 that for us to do 15,000 crores, we will need to open 1,500 branches. At that time, when we had come out with the, which is about 2 years back, we were at about 1,050 branches. As we speak, Gautam, we have, in fact, we upfronted the cost and we opened all the 1,500 branches. Although the vision 25 said we'll open 1,500 branches by end of FY25, but we've kind of, as we speak, we are already at 1,575 branches. Another 1 month, the residual about 50 odd, because what happens is when you launch, you really don't do a mathematics exercise. I mean, it's a whole effort which goes basis, some very long and very well drilled analytics that we do as to where does one open a branch. So, so that's why we kind of exceed. Most of the times you'll end up exceeding. That's what we've done. So now next year, there is no new branch opening. We'll at best open 100 branches. Those are split branches, because when branches reach beyond manageable proportion, say 15 crores, 20 crores, you have to split them for administrative purpose. So apart from that, so the next year is all about, Gautam, the productivity unlocking. It is all about optimization. It is all about efficiencies. So branch opening, tick box done. We said the credit loss will be south of 2%. We are very much on track. So we are very much there. We had said that the NIMs are the ROAs are. We said that the ROAs will be upwards of 4.5%. As we speak, all the quarters that we've the results that we've come, it's upwards of 5. Although we keep on maintaining that it will be 4.5. Is sustainable basis, 4.5 is a good number to look at, and that's what we are going to do. NIMs 13.5% is a given, should happen, and we are very much on course for it. Cost of fund, which was the biggest thing in our whole scheme of things, because we borrow to lend. When we started at a very, very high, because of the background and the transition and the other disruptions that I mentioned. We started at a cost of fund of almost about 13.5%. We are down to 12. We have internally taken up a target of reducing it in the next few quarters by at least 50 to 75 bips, and then we'll keep on, assuming the environment to be stable, we'll kind of keep doing it. We'll keep on progressing on that. So overall, I think, Gautam, as I said, we've tick boxed almost all of it. Still a year to go, but we are very well on track.
Understood. I guess the other big question really is with respect to moving from a monthly collection model to weekly. I think that's a big move internally for an organization to get, of course, the field force to actually adapt to that. So that's question, that's the multiple questions I have around that. One is, of course, how is the organization adapted to that? Secondly, has it started having a bearing on the collections and in turn the credit cost? Has that, what's been that transition like? That's really, the question I'm looking at. And then how are the recoveries from the customers who delayed paying their EMIs on account of the transition? I mean, when will this normalize? Really, that's the question I have.
That's a very good question, and I said this. There are popular decisions, there are tough decisions, and then there is a third one, which is so all of this is a part and parcel of the business that we deal with. We as a company have not shied away from taking tough decisions just because we thought that they were the right decisions to take. The 700 crores of write-off was not an easy decision. We got a lot of feedback because when we were engaging with the various stakeholders, everybody said do it in pieces, don't do it in one go, and so on and so forth. So so at that time also we thought that we listened to our instinct, and we thought that is the right thing to do. Similarly, weekly is one such example, Gautam. Moving from a monthly to weekly, to your question, neither will a customer like it nor will a employee like it, because it's not something which is either or. But if you drill a little bit deep, and let me give you an empirical evidence, and then I'll come back to to what we've done. Weekly, on a 30,000 loan, a weekly installment will be roughly about 640, 650 or thereabouts, give or take 10 rupees here and there. Whereas a monthly installment is about 2,500 rupees. From a customer point of view, she will always be hesitant to walk the weekly way because she has to come 4 times in a month. That's the typical challenge. It is a mindset challenge, nothing to do with the, sort of the tickets, the payment size or the liability size. If you ask her, however, what do you think is easy to pay, a 640 or a 2,500? 100 on 100 will say 640. Because obviously arranging 640 is not very difficult. 2,500 is a big one, number one. Number two, when you practice a joint liability is the women are sitting there and you say, okay, Sunita Devi के पास अभी आज के दिन में 640 रुपए नहीं है, आप में से who's going to pool to get to the 640. I can bet it will take less than 5 minutes for all of them to pool the 640. To pool a 2,500 obviously doesn't take 5 minutes, it takes longer. Yeah. So our belief is very, very strong, and we are converted as far as the weekly model is concerned. Let me give you empirical evidence. Number one, the biggest microfinance company, before it became a bank, was Bandhan. It was 100% weekly, and then it slowly, since it's a bank now, obviously, it will kind of change its for depending on what product you're selling. Number two is my previous organization, 100% weekly, without any, it wasn't a 1% also, 100% it was a weekly model. Number three, the third largest company in microfinance today is Credit Access Grameen. It is 100% weekly. So what more evidence do we need to say that, a weekly works well? And, the Credit Access, you've seen the results, etc. It's a great quality as far as the company is concerned. So the point is that at some stage you have to change it, and we are convinced, and hence we are moving the whole company there. In the process, to your question, have we had difficulties? Yes, 110%. Is there something that surprised us? Yes. And I personally, I kind of stand up and I raise my hands and say that, look, I probably misread from a timing perspective. I would have said that, and what was playing in my mind, we would take about 3 to 6 months to kind of do it. We've probably taken a quarter more. So that's the learning, and there are a lot of learnings which we'll kind of do. We'll kind of incorporate this when we do the second phase. But broadly speaking, customer point of view, if we go and tell the customer that, look, this is good for you, you have to do a lot of talking, which is what I thought. I would have thought that, ye kya farak padta, she's either way paying. Let us go from weekly to first, from a date to a day and day to a week. But it isn't, because you are dealing with, at that time, we impact, this whole project impacted 1.6 million customers. So 16 lakh customers with about 6,000 people, is a lot of communication. And for the, the situation that all of us were in, it probably took a little longer. Have there been flows, to your question? The answer is yes. Have there been elevated GNPAs? The answer is yes. Are we aware about it? 110%. We are fully seized of the matter. And hence, if you see our last results, there was some bit of elevated this thing. What is the extent to the problem, or extent of the problem? I can say with reasonable confidence, Gautam, that we are staring at the end of the problem. We are looking at the tail of the problem. Another, and in fact, if you go back to my earnings call of last quarter, we said that by May, we should be able to resolve this completely. And they are able to, and then the second phase is where, we obviously, because of the learnings, etc., will be very, very, calibrated in this whole thing. But outside of that, how's the growth story? The growth story is super. How's the collection story? Collection story, barring this disruption, is absolutely fine. Number three, how are we doing on the geographical spread and the weekly disbursements that we started? In fact, this is the first time I'm kind of revealing it, Gautam, that in a weekly model of the new branches that we have opened, now they contribute almost about 24% to our disbursements. So that is a quarter of the disbursement coming out of the weekly branches, which are only 500 odd. As we keep churning, as we keep changing, by end of this next year, which is FY25, we will have at least about 65 to 70% of disbursements coming in the weekly cycle. And once this cycle keeps on, then see, this is a very, very, and it's very important for all the people on the call to know. We have 3 tenors. There's a 12-month loan, there's an 18-month loan, there's a 24-month loan. there are three types of, and we introduced the 12 and 18. This company had only 24 months. We came, we knew, because having been in this market, we knew that not every customer wants to stay for 2 years. She wants to roll over the loan fast so that she can apply for a higher loan. And that's what they do. So our average maturity, our average asset maturity is about 9 months. Our average liability maturity is 10 months. So actually this is a positive ALM mismatch if you were to see. So we kind of churn this pretty quick, and that is what is happening. So our sense is that Gautam, we are very positive that yes, it took a quarter and a half extra, more than what we had anticipated. But then once again, it was the right thing to do, and we are well on course to kind of, put this aside and then move on to our regular work.
The other question really is, within 4 weeks, we have the 18th general elections starting. Is that a cause of concern, not for Spandana specifically, but for the microfinance industry in India, that some irrational political party could say, if we were to come into power, we will write off all of these microfinance loans? I mean, is that a concern within the industry?
Is it a concern or is it a risk? I would say yes, there it is a risk, but history has it that the last ordinance was the Andhra ordinance which came, which too got overturned. That was in 2011, and 2022 is when it got 23. Sorry, it got overturned by the High Court judgment. So and then there is one example only, Gautam, which was the Assam, the Assam state, where the chief minister said specifically that I will sort of write off, and please come, I will pay off, because somebody has to write a check at the end of the day. If there is nothing called for a private loan, there is nothing called a write off. Somebody has to put the bill, and there's no free lunch. So that is what happened, and it was an exception. It was an aberration, but our constantly deal with the, we have a lot of dialogues. We have very strong SROs in our industry, who kind of deal with all the stakeholders, which includes the regulator and which includes the political class as well. We have reasonable confidence and assurance from them, because they also understand that what you are doing is not just writing off, you are destroying the fabric of and the culture of lending and collecting, because it is a loan from a microfinance private entity today. Tomorrow it could be the government loans as well. So nobody wants to tweak or touch the core of the lending practice and the principles around the lending practice. So and we've seen multiple elections over the past many years, including general, including state elections, etc. My personal opinion is that one should be aware about what is happening. One should know what is happening. Is there a risk of somebody getting up tomorrow saying I'm going to write off? I would say highly unlikely. So that is not an option, or that might not happen, is my reasonable sense and understanding of this market and the various stakeholders, which includes the government as well.
Sure. What I want to do now, Shalabh, I think this has been a good starting point for now opening up to Q&A. So participants, I request you to raise your hand, and I'll unmute you, and or you can put it on the chat, and I'm happy to ask the question if you don't want to necessarily ask it yourself. We have a question that's come in that says the Parivartan project has been implemented for the 700 branches, although these are comparatively smaller branches. This has taken more than estimated given the challenges. The bigger question and proof would be when the same is to be rolled out for the larger branches.
Yes, so as I said, the Parivartan branches, there were about 714 branches where we launched this. It wasn't small branches. They were practically about 47% of the book, so almost 50 cents to a dollar, so almost half a book. We said that, when we rolled this out, there have been learnings. Yes, there were challenges, but there are a lot of learnings. And hence, the phase 2 for the other branches which have not been in Parivartan will be very, very calibrated, and we will take one step at a time. because we are also wizened by whatever has happened, and whichever way we've kind of progressed on this, we now know and fully understand as to what were the reasons, why did it not go the way we had anticipated. And although we are almost out of that whole issue, but the next 50%, be rest assured, we are not in a hurry either way. We don't have a mandate from anybody to do it immediately. you know uh, the rest assured, it will be very calibrated, and we can we do not foresee, I mean, we'll take one step at a time, let me put it that way.
Got it. The other question that's just come in is the RBI has lifted the spread cap, and hence the entire industry has seen margins expand to 12 to 13%. But recently, the regulator has come down heavily on the industry for charging higher rates to borrowers. So, where do you see yields and margins basically stabilizing?
So look, a regulator knows so much that you and I would not know, because they have access to data which is industry level data. They are very sharp, they are very smart, and they understand this whole financial services more than any of us. So to that extent, you have to give credit to the regulator, number one. Number two, let me give you some piece of statistics. Microfinance is now a 4 lakh crore industry. I'm talking about the joint liability group. If you include the SHG, that is another a lakh and 30 lakhs and 40,000 crore. I'm keeping the SHGs out because that's more a state government program equivalent. JLG is about 4 lakh crore. There are about 210 odd registered microfinance companies, and then there are banks which are which are kind of which have their own subsidiaries, kind of engaged in microfinance. So if I were to, however, there is a skew in this industry. The top 15 microfinance players contribute about 90% of the 90% of the industry. The balance are all, they operate in pockets, 100 crores, 50 crores, 70 crores, 150 crores type of companies. So, so I can say with reasonable surety that these top 15 players, Gautam, the average rate at which they lend is about 23.99, about 24%. 24% is a 2% per month is in my view, for the effort that is involved, because this is a last mile delivery. This is a high cost model. While it is a high ROI, but it is a high cost model as well. You incur, and then there is that always uncertainty, since it is a unsecured loan. So those added issues are always there. But my sense is that the nudge from the regulator was more to the entire industry, which includes people who are in the 15 and outside of the 15, because that's a larger chunk. That's number one. Number two is also the banks. The bank's cost of fund is about 5.5%, 6%, and they charge almost equivalent of us. So the nudge was there as well. That if my cost of capital is 12% and I'm charging a 24, and a bank's cost of capital is 5.5, 6, why is it charging 24? So it is so that is a contextual discussion which one has to look at. But if I go back, and sorry, I'm being slightly more elaborative, but very important to communicate this. If you go back, turn the clock back before this free pricing regime came about, what did the Reserve Bank say? The regulator said at that point in time that there was a cost plus 10%. That was the allowable margin. So 10% was the allowable margin, which was at that point in time. So whatever was the cost, and there was a definition. And then you had a MCLR into 3, and there was a calculation, and then you were allowed a 10% of margin. If I do a like to my current balance sheet, forget the free pricing regime. Instead of, and this is after COVID, and the times have changed, the industry has also changed, customers have also changed, and so on and so forth. Instead of the cost plus 10, today I am at a cost plus 11.2 that we've declared in our last earnings call deck, if you see the investor deck. So what are we saying? With the passing times, I'm talking about Spandana, and so I representative across, the range would be anywhere above the 10. It will be about, somebody would be at a 1075, 1080, somebody would be at 1110, 1120. So that's the only difference that we are talking about. So we are communicating it, and at the same time, the message of the regulator has not been lost on everybody, which is, if there is margin, please pass on the benefit to the customers. The good quality that we are sourcing post-COVID obviously has helped a lot in times of, passing on the benefits. We also have kind of cycle 5 and above. We've just changed the system and we are waiting for the month to end. Once the month ends, we will be depending on the vintage of the customer. We'll be reducing the IRR by about 50 bips to about 90 bips. So all of these things we keep on doing, and it has nothing to do with the nudge or whatever. That's the right thing to do. So that's
Got
what
it.
just to end, where do we see this settle? I think as at Spandana, I think, a 13.5% or thereabouts in the neighborhood NIM is on a sustainable next 2 years basis is a very much doable thing.
Okay.
Shalabh, I have a couple of questions here in the chat box.
Yeah.
One is the first one is from Ketav, where he's written that the credit costs have increased in the third quarter across the industry. Is there any increase in early delinquency? And I'll just club that with Jagdish's question, where he's saying that excluding a major player in West Bengal, how would you see the asset quality as a whole? Are there any asset quality warnings you see?
Look, there is you would have read in the newspapers, there is some Karza Mukti, something, which is going on in a specific state, which is Punjab. So it's a localized, isolated communist, led by small communist groups, who kind of sort of built it up. So people who are engaged in microfinance activities in Punjab, we don't have any book there. Our portfolio exposure is zero in Punjab because we never wanted to grow in that state for a different reason. But to answer your question specifically, we except for, and it hasn't spread, so because people are aware, it is just that, I think another a month and a half to 2 months, that problem also should be resolved because the SROs and the companies are, along with the local administrations, are after that. Just trying to isolate that localized problem, and it should get resolved at best a month and a half, is my guess. That's number one. Number two, to answer Jagdish Sharma's question, excluding a major player in West Bengal, how would you see the asset quality as a whole? Asset quality as a whole, we are getting collection efficiencies of upwards of 97%. 97 to 98% is something that is a decent number to clock. All of us are experiencing it. We are definitely experiencing it. Loss of around 2%, credit loss of 2% and below is a good number to target. We are very much on track, and I think we are there. At an industry level, I think, that is a number, 2.5%. There are some people who go up to a 2.6% also from their comfort point of view. I think if the balance sheet allows, to each one his or her own. So that shouldn't be. So Jagdish sir, to answer your question, across the industry, in fact, Tamil Nadu came out with the floods very, very fast, and Tamil Nadu also, the first state which came out after COVID, was one of the best. It has displayed the best behavior. So, there is no state that we are seeing which are showing any signs of stress or anything. Elections will come and go. That should not be a problem.
Just a question that's come up to me on my WhatsApp. With respect to your non-MFI business, non-microfinance business, where do you see that, by say 2028, on your vision 2028? How could that become?
So I'll first cover the Vision 25. In Vision 25, Gautam, we had said that we will build a book of about 2,000 crores in the non-MFI book, which is our subsidiary. So just for the benefit of everybody, we have a flagship company called Spandana Sphoorty, and we have 100, which is a NBFC MFI. It is registered as NBFC MFI. We have under its umbrella, we have a NBFC only, which is called Chris Financials. It is almost 100% subsidiary. That is where we book all the non-MFI business. There are three businesses. There is one, individual loans, which are unsecured loans, number one. Number two, these are to individuals. Number two is the loan against property. That is number two. And number three is loan to retailers. So these are the three business lines that we book in that. We've expanded. Earlier, we had only the Chris operating only in two states, which is Andhra and Telangana. Now we've spread to Madhya Pradesh, Rajasthan, Tamil Nadu, and Karnataka. So 4 plus 2, 6 states is where we are going to be. We will end FY25 in the range of about 1,500 crores, Gautam. We will have a cumulative around 15,000 is the number that we had given end of FY25. We will still stick to that number.
Wonderful.
Yeah.
Yeah. The other
There's
question.
Yeah, there's one question. Sorry, Gautam, interrupting you. There's a question from Jagdish Sharma. There were two questions, in fact.
Yeah.
Talk us about individual loan versus group loan, and how do you
That's the asset quality deterioration in the MF companies.
how do you see both separately and these two? Where do you see the problem? Look, so Jagdish, we are strong believers in microfinance and joint liability. Individual groups, companies are doing, and this is a very important point. And Gautam, please, you'll have to indulge with me in this. I will spend some 60 seconds.
So please.
Companies, so Reserve Bank came out with a criteria which was more of FOIR related, in the sense that if you have your income at X, so Reserve Bank first criteria was if the household income. So first time the definition of microfinance was it spread it earlier it was just the women. It was expanded from women to a household. So what it said was if the annual income of the household is 300,000 or less, and if you give an unsecured loan, it gets categorized under microfinance. If the household income is more than 3 lakhs, then it is not microfinance. I mean, it is as simple and as basic as that. So what happened was, and then there are criteria. I don't want to kind of get into much details, but criteria in terms of what should be the size of your liability if it is a microfinance loan. So what companies have started doing is they have started lending long. Because if I have to fit the installment criteria in the definition, I have to give a longer tenure loan, and so that the installment size goes down. And if the installment size goes down, I fit into the Reserve Bank criteria. I mean, this is broadly the way companies have started doing it. As far as we are concerned, our attitude is a very conservative attitude when it comes to all these risk management principles. I said we love weekly. I said we love geographical concentration, as in, we like, about 12 lower concentration in a specific state is something that we like. That's number two. Number three, we believe in shorter loans, 12 months, 18 months. That is how we introduced, and so on and so forth. We believe that a tenor risk is the biggest risk in microfinance or in any unsecured loan. The longer the tenure, the higher the risk, because you don't know what is going to happen tomorrow or day after. So we have desisted from getting into a 36 months, 48 months, 60 months, which many of the companies are doing, which is, once again, they are seasoned enough. Everybody understands this, so to each one his or her own. But as far as we are concerned, we are at 24 and 12 and 18, and we'll keep on walking that path. To the specific question, individual loan, what companies are doing is to get them out of micro. If you want to lend loan long, you want to concentrate on ticket sizes and higher loan amount. That is when you get them out of the out of the JLG and into the individual loan. We are not in that camp. We believe that this industry, and there is enough statistics available, is penetrated only to the extent of 36-37%. You still have a lot of headroom. The total number of unique borrowers in this country of 140 crores is only 7 crores, only 70 million. That's it. So that's the headroom that you have. You do whichever maths, you will at best come to a 40% penetration. So if there's so much of headroom, why do you really want to take undue risk in terms of lending a higher ticket and so on and so forth? So we are not in the camp, Jagdish, on these individual loans, and we are very comfortable with whatever we are doing.
Okay. We have a question from Sandeep Dingra. Question is about evergreening. How do we, from the outside, tell whether a microfinance company is not evergreening loans, i.e., lend more to the same customer to pay back the older loans?
Yeah, but look, this evergreening is one. There are very clear criteria of the regulator, which kind of define what is a evergreening. One, two is, and that is very important. What one has to understand is this cannot be run infinitely. You cannot keep on running this model today, tomorrow, and forever. At a point in time, you have to press the pause button. It depends on the individual. Having said which, in a joint liability, sometimes the group exerts pressure and tells you that, please give, the lady was in problem, why don't you give? But that is far and few. It has to be a few percentage, a 1% or a 2% of your book, can't be a 20% of your book. So broadly, if you see the larger landscape, this is something which is not a long-term sustainable model. You can't keep on rotating, and when you are in a growth path, obviously, that doesn't really help, and it's not good for the business also from a discipline point of view. So, how does one know it? I mean, these things don't last forever. It's a matter of time before, you'll kind of get to know of it.
Sure. Yeah. The other question that I think specific to Spandana is banks as well as NBFCs are aggressively growing their microfinance portfolios. Are you seeing any sort of heightened competition or competitive intensity on the ground, and do you see a risk of over leveraging for the customer?
So the over leveraging part is answered by the Reserve Bank of India FOIR, which is the fixed income and the income and liability formula that they have come out with. So unless, and which is what I was alluding to just a few minutes back. Only way I can beat it is by increasing the tenure of the loan, which we are clearly not in that. So our rejection today is about 35-37%. Gautam, for 100 applications that I get, I say no to about 37, for where this is one reason. And I am not in the camp of increasing the tenure just because you want to do a loan.
Sure.
So and we are very comfortable. And I go back to the basic, your penetration at an industry level is just 37, 38, 36%. Why do you want to kind of do that? If I go back to the Vision 25, Gautam, we had said that our growth will come out of customer acquisition. And it's a very important point. This year alone, Gautam, in the 9 months, we've sourced almost 1 million new customers. 1 million. And there's still a quarter to go, and the quarter numbers are out. I think you only mentioned, in the Vision 25, we had said that we will end the year at about end of FY25 at about 4 million. As we speak, we will end this year at about 3.2, 3.3 million. So that also is a tick box. So the point I was trying to make was there are enough customers, and then within the customers also, let me give you one more statistics. Single lender customer, that is the customer having relationship only with me, is 36%. So 36% of my 3.2 million customers have a relationship only with me, which what it means is that just because you are offering a loan to the customer does not mean she will take the loan. She will only take what she can absorb. My relationship of 1+1, which is outside of me, she has one more relationship, another 36%.
Sure.
So 75% is 1 or 1+1, and you have to keep progressing this path. This is the answer to that competition part. The competition part is if you are very, very particular about the way you conduct business. The customer is looking for two things. The customer is looking for a steady supply of credit. When she wants, you should be able to give. Number two, transparency in the way you conduct your operations. If you are ticking these two boxes, no matter what, the customer also customer doesn't like if she joins 4 companies, she'll have to go attend meetings, across 4 companies. Why would anybody want to do it? So stick to one, you will get all the fulfillments from there, and you can kind of just fulfill all your credit requirements from one company, and that's what we are aiming at.
No, great. Shalabh, I promised you we'd end this by 6:30, so thank you so much. Ladies and gentlemen, I hope you found this fruitful. You obviously can reach out to Shalabh if you have any more incremental questions, but I guess it should probably do it after the results. And again, from Napian Capital and all of us here, Shalabh, thank you so much.
Thank you very much, and pleasure talking to all of you. Thank you very much.
Bye-bye.
Thank you.